It's been an interesting year. Some people might even say it's been more interesting than they would like. Welcome, everybody. Overall, as we're here to talk about our year in review, we had shown that during the pandemic that the real estate values were much higher and exceeded anybody's expectations or projections. Interest rates remained low. We were challenged with supply chain issues. The new normal was working from home. Ultimately gone through what I would say is an upward trajectory or appreciation cycle of the last 12 years. But times will change, and we are now at a softer part of that cycle. Inflation is something that I've been concerned about for the last couple of years and talked about in various group discussions. Interest rates went from being in the high to low threes at the beginning of the year, consistent low levels of inventory, to now, obviously, there at one point in time were interest rates that were challenging 7%. And they've also come back down because there just really wasn't any demand when it comes to that. But the fact that the Fed and the central bank have raised rates is because of some of the issues that we have, not just here in our country and in our marketplace, but globally. So the global supply chain issues, based upon some challenges on the geopolitical front, including the war in Ukraine and supply chain and now energy policy, are absolutely things that have contributed to where we are now. During this period of time in the pandemic, I would say that some of the silver lining that I've experienced, I know my family has and other friends of ours, is people just really reassessing and deciding what's really important to you, for you and your family, and how you wish to operate. Many people are also figuring out, well, what is the relationship with the company that they work with or they work for? Or, if you're an executive, how to interact with their employees to make sure that they are still acknowledged and know that they're a valuable part in order for people to continue to collaborate, and what is ultimately the balance going to be of that. When it comes to our real estate market, we are also still very fortunate here in that we are definitely insulated, not to the same in various parts, because once again, we have micro markets, but even the most expensive of our markets here, we're insulated, but we are not immune. And there is no marketplace here locally that has not been affected and has not softened. But one of the benefits for those who are homeowners is the fact that inventory levels have continued to remain low. One of the distinct changes in the market that we now have is that buyers don't have the same sense of urgency that they had, but I can tell you that we still have bona fide buyers that are out there. And that when it comes to interest rates, the interest rates are still, as much as some of us are licking our wounds that we're no longer able to get a loan in the neighborhood of 3%, the rates for strong borrowers right now are still relatively modest. Yes, of course, that affects the affordability and what the payments are, but the prices have also come down. So rates have come up, prices have come down a little bit. There are definitely buyers who see opportunity in the market now. And as far as sellers are concerned, you're still very, very fortunate. The bottom has not dropped out of the market. It just absolutely has not. So if you have a buyer that's looking for a steal, that's just not going to happen. At least if you have great representation. And also for homes that are well located, well priced, that are well appointed, there still is going to be a drive. You still have properties, some of which are selling in the first week on the market with multiple offers. Those buyers are not being as aggressive, not nearly as aggressive as they had been in the past. But for those homes that are on busier streets, have deferred maintenance, have an unusual floor plan, if you have what a buyer can perceive as an objection, those are the type of properties that are going to take more of a hit when it comes to the value of the home. So it may be difficult, but for those of you who are planning on selling, it's really important for you to thoroughly and properly prepare your home for the market to overcome the objections that a buyer may have. When we talk about the financial side of things, it's been quite some time now that we've not had a large amount of money coming into this marketplace from China. The current government there has really been turning down the water spigot, so to speak, and flight of money from mainland China to the US or parts of Canada, etc. Our stock market, though, when that started and we had less money coming from China, we did have a huge appreciation cycle of our stocks. And so you then had tech buyers and those in finance who then had significant amounts of money. They wanted to move those funds and assets from the asset class of securities and equities to now real property. Some of those people were moving up. Some of them were first-time home buyers. And again, interest rates were low. You had some folks that were getting lines of credit off of their stock so they didn't have to sell it and have to pay short-term or long-term capital gains taxes. They'd get a line of credit that frankly typically was less when interest rates were low, that was lower than your purchase money loans. And so now they had two asset classes working for them at the same time. They're putting significant amounts of money down. For those that are lying in wait to think, oh, a bunch of foreclosures are going to be coming, don't hold your breath. The type of buyer that's been buying homes since 2007 and 2008 has had more money down than previous cycles. They have had higher credit scores, and the criteria that they've had to meet in order to get those loans has been much more stringent. On top of that, the significant appreciation that we've had, people are in a tremendous equity position when it comes to their homes. So that doesn't mean that there's not good value. And the reality is that for the most part, the appreciation and tremendous appreciation that we saw in 2021 is gone. But back to the attitude of gratitude and knowing that you're fortunate as a homeowner, if you weren't in the market to sell, you haven't lost anything. The fact of the matter is that was theoretical money. I do not believe that you can go to an algorithm in your Zillows and your Redfins that is going to consistently tell you what a property is worth. That will work just fine in a subdivision when there are very like type of homes. But for your typical areas out here, that's just not going to be the case. But this has absolutely been a year of reflection where we get to, reassess and acclimate. I think it's important for us to really understand where we're fortunate. We don't have war on our soils. I think that the market's going to be like this from the stock market and the real estate market for the next 18 to 24 months. Depends on how recently you've looked at the news. 300, 400 points, 500 points going up. However, just a few days ago, it had dropped 300 points. So that sort of up and down, frankly, is something that I've been anticipating and expect that we will continue to experience for some time. When it comes to interest rates, fortunately, inflation has come down. Our GDP in the last couple of months was quite positive. However, a lot of that drive was coming from exports to Europe. So I don't know that we can actually continue to rely upon that, because ultimately we'll see what happens after this holiday season with the retail sector, which is 2/3 of our GDP, and whether people with their consumer confidence are still spending. The Fed, this is the first time in my 29-year career that the Fed has made good on every promise that they've made when it comes to how high they're going to raise interest rates and how often they're going to raise interest rates. Typically, it has not been nearly as much as they've said. Well, they're meeting that promise now, and they need to meet that promise because inflation is stubborn. Fortunately, with inflation having come down, consumer confidence is still high. We are anticipating that rates are going to go up again, but not quite as much at the beginning of the year, and we'll see where that all washes out, because ultimately when it comes to wages and job growth and employment and in unemployment, they're trying to get the unemployment numbers up in order to just cool things off and hoping that we have a soft landing. I hope that people find this helpful and also encouraging. If you ever have any questions about the market, I would be happy to sit down with you and chat about it. And on top of that, if there's anything that I can do for you, I would be happy to. I look forward to your call.